Welcome to our exploration of an important accounting rule, IPSAS 29. IPSAS stands for International Public Sector Accounting Standards, and IPSAS 29 deals with financial instruments. These tools are essential for managing public money. Understanding this standard is key for public finance, ensuring clear and trustworthy financial reports. Public sector organizations manage vast sums of public money using various financial tools. Proper accounting for these instruments ensures transparency and accountability. IPSAS 29 provides the framework for this crucial task. Financial instruments are contracts involving money like loans or investments. Governments and public bodies use these instruments daily, making a dedicated accounting standard necessary. Consistency in reporting these items is vital for comparing financial health. Our goal is to make IPSAS 29 accessible and demystify its requirements. Good governance relies on clear financial information, and IPSAS 29 plays a significant role in providing that clarity. Join us as we delve into this standard. Let's unlock the world of public sector financial instruments together. Let's first look at the scope of IPSAS 29. This standard applies to all public sector entities using the accrual basis of accounting. IPSAS 29 covers a wide range of financial instruments, including most financial assets and liabilities. However, it excludes interests in subsidiaries, associates, joint ventures, employee benefit plans, and insurance contracts. Understanding its reach and exclusions is the first step. The core objectives of IPSAS 29 are clear and focused. It establishes principles for recognizing and measuring financial instruments. Proper disclosure is also a key goal, providing relevant and reliable information for users of public sector financial statements. Users include citizens, legislators, and creditors who need this data to understand an entity's financial standing. Governments and public entities manage diverse and often complex financial portfolios. IPSAS 29 provides a consistent framework for accounting for these activities. This consistency helps in assessing financial risks and evaluating performance in managing public resources. Ultimately, it promotes greater accountability and transparency in government finance. This is crucial for building and maintaining public trust. Understanding IPSAS 29 is essential for anyone involved in public finance. It ensures that financial instruments are accounted for accurately and transparently. Let's first look at the scope of IPSAS 29. This standard applies to all public sector entities using the accrual basis of accounting. IPSAS 29 covers a wide range of financial instruments, including most financial assets and liabilities. However, it excludes interests in subsidiaries, associates, joint ventures, employee benefit plans, and insurance contracts. Understanding its reach and exclusions is the first step. The core objectives of IPSAS 29 are clear and focused. It establishes principles for recognizing and measuring financial instruments. Proper disclosure is also a key goal, providing relevant and reliable information for users of public sector financial statements. Users include citizens, legislators, and creditors who need this data to understand an entity's financial standing. Governments and public entities manage diverse and often complex financial portfolios. IPSAS 29 provides a consistent framework for accounting for these activities. This consistency helps in assessing financial risks and evaluating performance in managing public resources. Ultimately, it promotes greater accountability and transparency in government finance. This is crucial for building and maintaining public trust. Understanding IPSAS 29 is essential for anyone involved in public finance. It ensures that financial instruments are accounted for accurately and transparently. To understand IPSAS 29, we must first learn its language. A central term is financial instrument, a contract creating a financial asset for one entity and a liability or equity instrument for another. Examples include cash, loans, and shares. A financial asset represents something of value that a public entity owns or is owed. Cash, equity instruments, and contractual rights to receive cash are key types. Understanding financial assets helps identify what resources an entity controls. Financial liabilities represent obligations, usually to deliver cash to another party. Examples include government bonds and loans. Equity instruments for public sector entities usually represent net assets or residual interest. IPSAS 29 also introduces crucial measurement concepts like fair value and amortized cost. Fair value is the market price, reflecting current conditions and expectations. Amortized cost is used for many debt instruments, adjusting the initial amount over time. The effective interest method calculates this amortized cost. These concepts are fundamental for valuing financial instruments correctly. Understanding these terms and concepts is essential for applying IPSAS 29. They ensure that financial instruments are measured and reported accurately. This knowledge is crucial for anyone involved in public sector accounting. Section 4. Bringing instruments to book recognition and measurement under IPSAS 29. When should a public entity record a financial instrument? This is the question of recognition. An entity recognizes a financial asset or liability when it becomes a party to the contractual provisions. IPSAS 29 generally requires financial instruments to be measured at fair value when first recorded. After initial recognition, the value of financial instruments can change. This is subsequent measurement. Understanding recognition and measurement under IPSAS 29 is crucial for accurate financial reporting. Section 5. Illustrating IPSAS 29. Practical examples of financial instruments. Let's make these concepts clearer with some practical examples. Consider a national government issuing bonds to fund an infrastructure project. These bonds are a financial liability, recognized at fair value. Bonds are measured at amortized cost. Interest expense is recognized using the effective interest method. Now imagine a public university investing in shares of a publicly listed company. These shares are a financial asset, recognized at fair value. Transaction costs are included if not classified as fair value through surplus or deficit. Measurement depends on classification, with available for sale shares remeasured to fair value at each reporting date. Changes in fair value are recognized in net assets or equity until sold. Alternatively, they could be at fair value through surplus or deficit. Consider a municipal government providing a loan to a local business. This loan is a financial asset, recognized when disbursed and initially measured at fair value. Directly attributable transaction costs are added, and subsequently, the loan is measured at amortized cost. Interest income is recognized over the loan's term using the effective interest method. Finally, a government entity managing currency risk with a forward contract. This derivative is recognized at fair value when entered into and remeasured at each reporting date, with changes recognized in surplus or deficit. Section 6. The Ripple Effect. IPSAS 29's impact on public sector reporting and decisions. The adoption of IPSAS 29 has a significant positive impact on financial reporting. It leads to more comprehensive and detailed information about financial instruments. Public sector entities must disclose extensive details about their holdings and associated risks. Financial statements become more transparent and comparable across different entities. This clarity is a cornerstone of good public financial management. IPSAS 29 also improves risk management practices by making risks more visible. This prompts public sector managers to identify, assess, and manage financial risks more effectively. The enhanced information provided under IPSAS 29 leads to better decision-making. Reliable data helps managers and governing bodies make more informed choices about investments, debt management, and resource allocation. Increased accountability is another important impact. IPSAS 29 makes public sector entities more answerable for their stewardship of public money. Detailed disclosures allow for better scrutiny of financial activities. This transparency helps build and maintain public trust in government institutions. When finances are clear and open, accountability flourishes. This is vital for a healthy democracy. Understanding IPSAS 29 is essential for anyone involved in public finance. Section 7. Conclusion. Mastering IPSAS 29 for transparent public finance. IPSAS 29 is a cornerstone standard for public sector accounting. It provides comprehensive guidance on accounting for financial instruments, including recognition, measurement, and disclosure. The standard covers a wide array of instruments from simple loans to complex derivatives. Its principles bring clarity and consistency to public financial reporting. Understanding its requirements is essential for anyone involved with public funds. The importance of IPSAS 29 extends beyond accountants to policymakers, auditors, and the general public. When government financial dealings are clearly reported, everyone benefits from the transparency. The benefits of diligently applying IPSAS 29 are numerous and far-reaching. It leads to improved transparency, better decision-making, and strengthened accountability. These are fundamental elements of good governance and responsible stewardship. Mastering IPSAS 29 is a significant step towards more robust, reliable, and trustworthy public financial management. It ensures that public money is managed wisely, prudently, and openly. In a world where public resources are often scarce, this is paramount. IPSAS 29 provides a framework that supports the public interest. Embracing this standard is embracing a future of clearer public finance,